Trade and economic policies have a significant impact on financial markets, as they shape the overall business environment, investor sentiment, and market dynamics. The implementation of trade policies, such as tariffs, quotas, and trade agreements, as well as economic policies like monetary and fiscal measures, can affect various aspects of financial markets, including stock exchanges, currency markets, bond markets, and commodity markets. Here are some key ways in which trade and economic policies influence financial markets. Stock markets. Trade policies can directly impact stock markets by affecting the profitability and competitiveness of domestic and international companies. Tariffs or trade barriers imposed on imports can raise costs for companies that rely on imported goods, impacting their profitability and potentially leading to lower stock prices. Conversely, trade agreements that reduce barriers can open up new markets and boost the performance of domestic companies, leading to higher stock prices. Economic policies, such as interest rate changes or fiscal stimulus, can also impact stock markets by influencing investor sentiment and economic growth expectations. Currency markets. Trade policies have a significant impact on currency markets. Tariffs or trade restrictions can create trade imbalances and affect exchange rates. For example, if a country imposes tariffs on its imports, it may result in a stronger domestic currency as it reduces the demand for foreign currency. Conversely, trade agreements that promote free trade can lead to a weaker domestic currency due to increased demand for imports and capital outflows. Currency fluctuations can have far-reaching consequences for international trade, cross-border investments, and multinational corporations, affecting their revenues, profits, and financial stability. Bond markets. Trade and economic policies can influence bond markets through their impact on interest rates and inflation expectations. Monetary policies, such as changes in central bank interest rates or quantitative easing measures, can affect bond prices and yields. Lower interest rates tend to push bond prices higher, as they increase the demand for fixed income investments. Conversely, higher interest rates can lead to lower bond prices. Economic policies that affect inflation expectations, such as fiscal stimulus or government spending, can also influence bond markets, as inflation erodes the purchasing power of fixed interest payments. Commodity markets. Trade policies play a crucial role in commodity markets, as they can directly impact the supply and demand dynamics of various commodities. Tariffs, quotas, or export restrictions can disrupt global supply chains, leading to supply shortages or higher prices for certain commodities. Economic policies that affect economic growth, such as infrastructure spending or regulatory changes, can also impact commodity markets. For example, increased infrastructure spending can boost demand for industrial commodities like steel and copper. Similarly, policies promoting renewable energy can affect the demand for commodities like oil or coal. Investor sentiment and risk appetite. Trade and economic policies influence investor sentiment and risk appetite, which can impact financial markets' overall performance. Uncertainty around trade policies, such as ongoing trade disputes or the potential for new trade barriers, can lead to market volatility and investor caution. Similarly, economic policies that are perceived as favorable, such as tax cuts or regulatory reforms, can boost investor confidence and encourage risk-taking. Changes in investor sentiment can affect asset prices, market liquidity, and the overall stability of financial markets. It's important to note that the impact of trade and economic policies on financial markets can be complex and multifaceted. Market reactions are often influenced by a range of factors, including market expectations, geopolitical developments, and global economic conditions. Additionally, the specific nature and timing of policy implementations can also influence their effects on financial markets.